turnaround after initially falling to two-year lows this morning. Let's get a clearer sense of where this region is headed. With Darius Kawacek, Chief Investment Strategist at CFC Seymour. He joins us live from our Hong Kong studios. Darius, good to have you with us. Is this turnaround in the markets today anything to get excited about?
I don't think so. I believe that this is a short-term rebound from the two-year lows where the region descended yesterday. And the recovery is partly driven by the fact that S&P 500 futures are up this morning, and partly by very positive sentiment coming out of China, where stocks have continued to rise. But again, I think the gains there are also driven by a short-term shift in sentiment.
So Darius, Rebecca in Europe here, short-term rebound today. Where does that leave us in the next few days? Should we expect to go lower all over again?
I think that the likelihood of further declines is fairly substantial given the continued negative information coming from the area of the U.S. financial sector, where downgrades continue, and there is increasing evidence of further write-downs on the cards on various investments due to, for example, sharp declines in house prices. So sentiment coming out of the U.S. will be negative, and the rest of the world, as usually happens, will probably follow.
Darius, you know, Shanghai market really surging today, up 6% at one stage. Hopes of a stimulus package by the government. If true, could this somehow call a bottom to the Chinese stock market?
I think that the Chinese stock market is oversold fundamentally, particularly when you look at price-earnings ratios, and therefore I wouldn't be surprised if a more lasting rebound take place there. However, you know, it's so very difficult to call the bottom because sentiment there is very fragile. One point that is really important is that China is in a relatively good position to engineer both strong support for its economy and for its markets, because both monetary and fiscal policy there is very restrictive, which means which makes it relatively easy for the government to ease either the interest rate stance or the fiscal policy at a time when inflation is declining. And I think that we will see further, especially fiscal support for the economy, which would be definitely a favorable factor for the equity market.
Darius, we continue to get really difficult data out, particularly in the US yesterday, I'm thinking. How should we be considering the movements in the Asian markets in the light of what we're seeing continuing to happen in the US?
Well, I'm actually surprised that Asian indices have not declined today, because the data out of the US was definitely a very detrimental mix for equity investors. We saw very negative numbers from the housing construction segment of the economy and from weekly retail sales reports. At the same time, PPI surged to 27-year highs. A simultaneous deterioration in growth outlook and in price stability prospects is always negative for equity investors, and has to be reflected in declines in valuations in the US. This sooner or later will be felt by investors in Asia as well. So I think that aside maybe from China, it would be very risky to take long positions in other indices in the region.
Yeah. Okay, thanks for that, Darius. Darius Kawacek there, Chief Investment Strategist at CFC Seymour. Well, coming